Hey guys, welcome to another video. I'm doing an update video upon request on Petro China. It's been almost a year. It's been 10 months since my last video on Petro China, and there's been some changes in prices, of course, so let's do an update. First, let's look at the chart. When I made the previous video, it was around that 31 level. 31, 32, and there were reasons that I liked the stock, including that the price to sales, price to book, a lot of the financials were good. It had been beaten up and come down from 60s. It was in the 30s to high 20s, and it looked like it was turning around based on volume and the indicators. So I put on a position and it worked. It's worked so far. I'm no longer in it. The trade was around 70%. I got out before that, but I just want to show that it did work, and the habits that we're trying to build is staying consistent with research on sales, financials. Those are the things that work, and then we put on some technicals to make good decisions. Of course, the trade wasn't perfect. I didn't buy the bottom, and I didn't sell at the top. But that doesn't matter. What matters is trying to make sound, rational decisions on investment choices. So that's the update on the chart itself. If you look at the big picture, it's rebounded some. Let me plot a moving average. I have 100, that's 100 week, but let's look at the 100-day. And once it started rising and the trend formed, it's continued. So that's all we can really see from looking at the chart. The price to sales ratio, this number is not accurate, but it was closer to 2 times sales, and now it's 4 times sales. And when we look at the financials, we'll get a good idea of where it's at and where it's going. But all we know is that it was really cheap, and it's a little less cheap, and the trend is up currently. Hopping on over to Seeking Alpha, they've got some good data that I like to use. Let's look at firstly the big stuff, the most important stuff. Something like the market cap is 161 billion US. We have the dividend rate, a fat 8%, 8.88. I think it was closer to 10, if not more, back when we were looking at $31. I don't remember the actual dividend rate, but that was a reason I was looking initially, and it has paid dividends. The price to earning ratio is 7, so not expensive. If it continues to grow the dividend, you would expect maybe a higher PE ratio if it at all has any chance of growing. Let's scroll down to the revenue. The revenue is not expected to grow very much. If you look at this, it's really just like a sideways. There's no rising revenue. There's slight rises expected, but not necessarily anything we would call a growth stock. If you look at the revenue, 400 billion. On the 161 valuation, or the market cap, the 400 billion puts it almost at 2, actually half times, 0.05 sales. So close to this number that they have here of 0.69. So it's definitely not a growth company, because a growth company would be valued at a multiple of sales expected to grow. If a company is going to grow over 10 years or 5 years, you expect that sales number to grow a lot, and that's not the case right here. It's a $161 billion company, and it's way under 1 time sales. So it is very cheap. The PE is cheap. There's a lot of reasons to think that it is cheap based on the accounting, but it's a lot of that political risk, geopolitical risk, China versus US, that's keeping this company cheap. If you're looking at the straight up cash flows, I would look at the PE and then discount the cash flows. I mean, the simplest way to do it is just divide it by 0.07, 0.08, which is just the natural discount of the stream. If I just grab my calculator, let's assume a 7. If you just divide 7 by 0.08, that would give you the perpetuity discount. This company would be valued around 87. The other way to do it is just to look at the dividend, and if you expect the dividend to continue to pay out and you're happy with the dividend rate, that would be another way to value the company. If you need to make 7 or 8% and you see that it's paying 8.8 and you expect the dividend to be reliable, then you would be attracted to the investment. If we look at some of the analysis and news, and you look at some of the headlines here, they are very bullish on the valuation. You see surprisingly solid yield, looking return to its former glory. It's become attractive after recent correction. Petro China is worth 41 per share. That was an old headline, but there's a lot of optimism in the headlines. Now, that's not necessarily the case for Chinese stocks. Recently, and even before recently, last year, there's been multiple waves of regulatory crackdown. So some sectors, like the education sector, that was turned into a nonprofit. Tech stocks have been getting cracked down. I remember another stock, Momo and Tantan, they got regulated. I guess they had too much promiscuous content. So there's a lot of crackdown and regulation that's threatening Chinese companies, as well as the ADR risk that a lot of foreigners aren't allowed to truly own Chinese stocks, and that still hasn't been tested, the whole ADR issue. So there are risks to investing in China, especially with the trend of getting more and more unfriendly to investors. So I do have to point that out. That's a real risk that has to be calculated into an investor's risk profile. Next, let's look at crude oil, which of course is a major factor on revenue and sales. If you look at crude oil right now, it's close to 80. It just came off from higher levels, and we're above a point where it did sell off. But it's also, there is more demand currently because the theme of inflation has kicked in. Look at this move. It was 21. This is a weekly line chart. It doesn't show all the spike that was even lower, but oil went from 20s to 80. So that's a 400%, a quadruple from the bottom. Normally I would expect a pullback, and this is just quite a strong move. Where do I see it trading? Probably somewhere around this 100-week moving average. It would be quite normal for it to pull back some, and that could affect energy companies going forward, at least in the short term. There is I did read some speculation that over the next, I would say years, because of inflation fears, there is a chance that oil, gold, all the commodity space sees more interest, more attention, more of a higher valuation if the currency, the dollar, stays or gets weak. It has been rising recently, and despite that, oil stays strong. So if we see oil prices head to 100, is that going to be good for energy companies? Most certainly it will. If we see higher rates, I also read that interest rates would help the energy companies as well. So we'll have to stay tuned for that. But after such a big move in oil, here's the daily chart, I would not be surprised to have it cool off and retest some of the range, maybe a third to a middle. So that might give a good opportunity to trade Petro China again, or a basket of energy companies like the XLF or an ExxonMobil, or maybe the exploration companies as well. Here's the XLE, the energy sector ETF with a basket of energy names in it. This one also went up, was in the 20s, mid 20s, went up to 56, did as good as ExxonMobil or Petro China. Oil quadrupled, and the energy sector ETF doubled, a little bit more than doubled. I do see it cooling off a little bit, maybe to the moving average, the 100-week moving average. So I wouldn't want to be starting a position right here, at least not a sizable position. Maybe it rises, maybe it falls, it's hard to say, but it's not as beaten up as it used to be, which made trades in the energy sector attractive. After a 100% move, you would expect, or you wouldn't be surprised if you saw some profit taking. Returning back to the Petro China chart, after looking at oil and looking at the energy sector ETF and also the analysis on the financials, because it's not a growth stock, there's not a big future in revenue, and there's some political risk that I would like to avoid. I have to treat this almost like a bond, and I want to buy it when it's cheap, and once the value is realized, I don't really want to own it so much and just hope that it becomes more valuable. I want to trade the swings, especially since it's still in a major long-term downtrend. So where would I want to buy it again? I would like to see it retest maybe the 40 level. There's a lot of supply in the 50 to 60 range, and because of that, I would expect some of these trapped longs to keep it around here as they unload their positions. So it's 52 right now, somewhere around 33, 32. I would love to trade it again because that seemed to be a good trade from the lows to the highs. Something like this, we could see a sell-off, push it down, and try to test support. And if it does go lower, that's when I would want to pick it up. Once the volume kicks in and it stops going down, I can try to speculate on a position right there. So do I think this is a good spot to buy it? I don't think this is a great spot to buy it. Maybe a call option, maybe a put sell. A put sell might actually be a very interesting way to play it. But it's not the same trade it was a year ago. It's no longer deeply discounted, and there's even more risk than before. So I actually would rather be in something like the XLF if I wanted to get energy exposure, which the same thing I would want to avoid. I'm sorry, I said the XLF, but I mean the XLE, the energy ETF. I would like to see it closer to the 40s, where it's at the 56 right now. And that trade would make more sense compared to now. Those are my thoughts. If you have any questions, feel free to put them in the comments, and I can try to find you the best answer. Cheers.